You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker and I, Niels Kostrup-Larsen, are back with this week's edition of the Systematic Investor series, where each week we give you a raw and very honest account of what it's like to be a rules-based investor, what news and articles caught our attention, and of course, where we also attempt to answer all of your questions. Morris is out this week, so Jerry, it's just the two of us. How are you doing?
Doing well. Good morning. It's early here. It actually might be morning where you are, but very.
Well, it's almost morning where I am. I know we are doing this at a slightly unusual time this week, but as they say, the early bird catches the worm, so I'm sure that's a good sign. Now, if you are tuning in for the first time, welcome. We love that you are here, and we're going to do our best to inform and perhaps even entertain you about systematic investing during the next hour or so. Now, just from sort of a high-level point of view, Jerry, of course, it's the end of a week, but it's also the end of a month. And since it is hurricane season in the U.S., we're all watching the big one coming towards you. I think in terms of trend strength and performance in August, I think it's fair to call the month of August a Category 4 or 5. It's certainly, on our side, catapulted our strategy to new all-time highs, our institutional program. But because there is a little bit of math when you run into bigger drawdowns, our original program with the high leverage is a little bit off the all-time high. But I want to start out by maybe taking a step back, and hopefully this is something that people will internalize a little bit, because it really goes to show how this strategy tends to behave. So when we were talking back in November, December last year on the podcast about, it had been a difficult period of time after the highs in January of 18, trend following as a strategy went into a pretty deep drawdown, I would say. When I look at our data, which goes back to 1984 when the strategy started, we kind of classify a severe drawdown in our original program, a drawdown of more than 25%, and for the institutional program, about half that. So back then, when we were looking at the numbers on our side, we could see that there had been 10. 11 previous drawdowns of this magnitude. And we could obviously calculate the depth and the average of those, and also the average length of these drawdowns. And so at the end of November, which turned out then to be the bottom, we of course didn't know that at the time, we could see that the drawdown that our industry and us, of course, as well, had suffered during 2018 was very close to the average, both drawdown in depth and drawdown in terms of length. And so, of course, this morning when I was looking at the final numbers for the month of August, I noticed that that the strategies were back at new all-time highs. And I was kind of looking at, so what actually was the result, meaning, in terms of the drawdown we ended up having, in terms of the length it took to recover. And what's really interesting to see is that during that analysis back in 2018, we could see the average drawdown was about 10 months on average, 10, 11 months. And the drawdown at the end of November was, in fact, 10 months precisely. But we could also see that the average recovery time was 9 months. And so now when I look at the numbers and I can, confirm that we've now recovered, the actual recovery time was 9 months. And of course, this is perhaps specific for our strategy this time around, but it's also something that obviously is very evident for the whole industry, that we have these, drawdowns of a certain size and length, but actually also the recoveries tend to follow a reasonably predictable pattern. Even though I will say, even after 30 years of doing this, it's always really hard to, when you sit, back then in during sort of the darker month of the year in December, and really think about what could happen that suddenly changes this difficult environment for trend followers to something that could be conducive to a strong recovery. But, that is just how it works. And I think this is why this is one of those strategies where you really have to be prepared to buy into the drawdown when it happens. If we look at August as a month and what helped trend followers to do well, of course, strong trends in fixed income markets have continued. I think the US 10-year bond is very close to making a new all-time low in yield. I think the 30-year bond actually achieved this during August. And of course, we've seen record low yields in many of the developed markets around the globe. But it wasn't really only fixed income that had strong tailwinds in August. Metals were pretty good. Silver had the biggest move, but in terms of performance contribution, at least on our side, it was gold. Wheat took the winning price, so to speak, in the grain sector, and we also saw pretty good performance from cotton on the softs. Energy markets were okay for the strategy. Equities mostly negative for the month, with the exception of Japan, where at least on our side, we're positioned for lower prices, so that helped out a little bit. And in the currency sector, overall, I would say probably a flat month for us, even though the dollar index managed to make a new closing high, at least since 2017, May, I think, at the close of business yesterday. So, I mean, all in all, it's certainly been a year full of surprises so far, but what probably wasn't that surprising was some of the news we got this week. The incoming European Central Bank President, Christine Lagarde, certainly made her opinion on monetary policy clear. She came to visit the European Parliament, I think, on Thursday, and she said, or she's quoted for saying, "I don't believe that the ECB has hit the effective lower bound on policy rates." So it seems like there is more to come, and it sure sounds like it could get a little bit worse for people who did what they were told many years ago. Save up for your pension. Buy bonds because they're a safe place to put your money. And of course, the pension fund system might also start to see some troubles with the liabilities they have. So maybe it's time to think about some diversification, perhaps even some trend following in those portfolios. So that was a little bit of my rant, Jerry, sort of what I had noticed and a little bit of an update on affairs on our side. How was your August, and what are your thoughts? How was your week?
Well, it's good period here in August, and then the year in general is going to go down as a good year. So far with the CTA trend following, reminded me of an issue we discussed a few weeks ago about how at some point in the future somebody will say, "Well, okay, you guys did well in 2019, but it was due to those negative rates. That's not ever going to happen again, so you can't expect that. Now, what are you going to do?" So I think one of the things that usually happens coming out of these drawdowns is we don't know what's going to happen. We're surprised by it. It's crazy. And this is what these type of systems pick up, things that have never happened before, and crazy market moves. One of our friends this week called these negative rates or these low rates vandalism. So I think it's really an unprecedented period, and that's what trend following is good at, things that were unprecedented.
Yeah, I mean, it kind of reminds me also about our conversation last week where we talked about this term, "this time is different," and I was quoting, Daniel Crosby, who I had just, interviewed for the podcast, which will be released soon. and where he was saying, well, these words can be very expensive. And I think you rightly pointed out, which I actually hadn't thought about, that in our world it's always different. And I think that's actually a great point, which I think just this year is really a great example of. And next year, who knows what it's going to be. The beauty of these portfolios that are so diversified is, of course, we only really need a few strong performance drivers to, have a great year. And this year it just turned out to be, fixed income so far, at least.
Our friend Sam pointed out this week on Twitter that he lost money in every single currency. I think back in January or February, his worst month ever, probably mine as well. So I think it was January, but that happens as well. Our diversification goes away. It doesn't help at all. And but just trading this particular style with that takes small losses and lets the profits run and is long and short. Lots of different economic currencies, commodities, stocks, and bonds. It shouldn't have drawdowns that are should have drawdowns that are shorter term than stocks only or anything like that.
Yeah, I mean, I did actually some analysis for a presentation, and I was going back to '84 when our current program started, and I was doing like a rolling return analysis of different time frames. And I think what might be surprising, because I think most people think that in the long run equities go up. So I did this rolling 3, 5, 10-year return analysis. And what's interesting about it, between the S&P 500 total return and the World Government Bond Index and then our own program, the only investment that does not have 100% positive rolling return windows over 10 years is actually the S&P. Meaning, in other words, you will have had periods in the last 30 years or so where even over a 10-year period, you would not have made money on being long the S&P. And I think people sometimes might forget that. But Jerry, good news on before we jump to your tweets. Good news, because when I checked recently, there was another voicemail for us. This time it was left by Seth, which we highly appreciate. So let me just play that for you right now.
Hey guys, this is Seth in Pawleys Island, South Carolina. Just wanted to leave you a quick message and say thanks for all the great content you guys come up with every week. As a individual trend follower who's only been doing it for a couple of years, I've got to say that the weekly show has been a great way to help keep me on track, taking the trades when they need to be taken and just keeping going with the system through this kind of recent bout of tough performance we've had. But I'm sure, like you guys, it's starting to get back on track, and I just appreciate all the good work y'all do. And I'm really looking forward to the live event in October. I'm signed up, and I really can't wait to spend the weekend getting to know you guys and getting to know the other attendees and just talking trend following and systematic trading. So that's it. Keep up the good work, and talk to you later.
Seth, thanks so much for your kind words. And we, on our side, very much look forward to seeing you at our live event in New York in only a few weeks from now. And speaking of the live event, I think we've got a couple of seats left. So if you still want to join us, don't hesitate too long, because when they're gone, they will be gone. Now, if you do want to leave us a voicemail, which we hope you will, so we can share them on air, you can just go to toptradersunplugged.com/voicemail. Now, back to our usual feature. Hopefully it was a busy week, a good week also in the Fin tweet world. I seem to remember having seen a decent amount of activity on your Twitter feed, Jerry. So maybe you can share what got a lot of attention and likes.
Activity doesn't always signal quality, Niels, but I'll leave that up
is
to
true.
You and the listeners. I have fun as usual. I was interested in a couple of things this week, different things than usual. Mark Holbert is a famous writer, and he wrote an article basically laying out the case that after taxes and after inflation, U.S. interest rates are above average. This fundamental valuation thing is so confusing, and I'd like to point out that everyone knows rates are too low or they're low. But if you look at it from another point of view, someone else's point of view, rates are actually above average. You can't base your argument that rates are low by any historical standard. If anything, as we've seen, they're above average. It's paying attention to price. It's so objective, and there's, maybe you have your system that's a little shorter term or longer term than someone else's, but I really appreciate just following the price and knowing where I stand from a trend point of view, and not having to try to navigate the markets with valuations and fundamentals and like this, because it seems to change a lot.
Yeah. I think it is interesting, right, that we probably, most of us perceive rates as being incredibly low at the moment, but then once you dig into things, you might actually end up with a different view on it. But it also reminds me a little bit about kind of yet another set of views and opinions coming, regarding our industry, but coming from Nomura, who are often getting a lot of press about because they try to anticipate the CTA signals. So there were an interview I saw this week. Also saw, I think there was a headline from another guy at Nomura, and they were talking about, imminent crashes and things like that. And so, of course, huge amount of information and potential sources for confusion, I think, for investors if you listen to all of that. And of course, I know I'm preaching to the choir because most of our listeners, do appreciate, kind of the rules-based approach. But I really do think that it's, it's such a great relief, really, that you don't have to pay attention to all of that. And even if you tried, I think it must be incredibly difficult to make any sense of it, let alone, trade based on these decisions. So, or news flow. So I agree with you, back to just looking at the one thing, so to speak. But yeah.
Another article I came across was one that sort of talked about, it's a research paper, and it talked about using trend following, but using different parameters, different look-back periods for entries and exits. And the point I picked up on this article was the statement that the performance dispersion across momentum strategy implementation tended to be larger than the dispersion between value and momentum. So just by trading a medium to long-term system with maybe 3 or 4 or 5 different systems with different entries and different exits, that product gave you a lot of diversification in those systems, sometimes more than value, than adding a totally different style or strategy. Even in our systems that all tend to be fairly long-term, it is possible for us to have one system long and one system short. I know we have some of those now. And so I think that if you spread it out even more, maybe medium term to long term, whatever that means to everyone out there, you would pick up a lot of diversification. And when you're, as I've said before, when you're making money in trades that are outlier trades, that all of your profits for the year are going to be probably based upon these mega moves, like the bond market is a good example, then it's critical when you go to exit those trades that you have some diversification. So, if you get lucky and get out, your shorter term system gets out, and that's near the high, then that's great. But you could get very unlucky and that would be not the best exit. So for years, that's my idea has been to have multiple entry and exit. Pretty good place to buy, pretty good place to sell, but more than one. And I think that helps with diversifying the returns, for the year. Big fan of that.
Yeah, I mean, we also on our side have not only multiple entries and exits, so to speak, or sub models. We also to run two different types of trend following inside our program, and it's interesting to follow those two, where you're clearly trading the same markets but doing it in two different ways as a trend follower, and to see the dispersion between those two. This year, not so much, but sometimes definitely, and over the long run, maybe the last 5 years, I've definitely seen some difference between the two approaches. But I was wondering, Jerry, when you think about dispersion in returns, do you think that, and maybe between different styles of trend following, and then you think about different managers, do you think that if you were on the investor side and you had to choose, do you think it's more important to choose people who have different styles of trend following or trade different markets? Where do you think most of the dispersion or diversification benefit comes from?
Yeah, I think it's. I think you should choose people who do both. Let's say so, trade lots of different markets. I think that's a good idea. Certainly, all the different categories. Like currencies, and grains, and metals, and base metals, and energy. So I think you don't want to leave any of those out. I think that, as I've said before, sometimes we can get in trouble by trading every single grain and every single currency without regard to their correlation, and sort of having on, basically you're diversified, but you're sort of overweighting the bets in some of those sectors. So you don't really want to do that. So I'm a big fan of these markets. I mean, when we sit back and we watch the money being made and we're basically sitting on our hands, not doing anything, we're very thankful that we're trading, the bonds or some of these big trends, the dollar, the currencies that we're short or long versus the dollar. So I have an amazing respect for these markets that are really going to make or break us. And we have to keep convincing people that they're fine and they're great, and the stocks are not inherently better trenders or superior in any way. And then when it actually starts to happen, I'm really happy about that.
Yeah, no, that's a good point. Now, while you find maybe the next tweet that you thought was interesting this year, it just dawned on me that next week is, I think, episode 52. That means we've done this for a whole year, every single week. So maybe that's an encouragement, perhaps, to our listeners, that if they do want to send us a special message on our 1-year anniversary through the new voicemail facility, that could be a great theme to hear your feedback, perhaps, as to how you found the first year of the Systematic Investor series. So just as a quick reminder, you can just go to toptradersunplugged.com/voicemail to do that. We would certainly love that, to hear more of your voices, since you are probably tired of hearing our voices every week. Hopefully not. We'll see. Jerry, what else did you come across of interesting articles, quotes?
I like this one from a article about a Swedish pension fund.
AP1, wasn't it?
Oh, yeah, that's right.
Yeah.
AP1. Nice guys. I liked what they were saying. The quote I picked up was, "The most important part of investment follow-up is to check if the historically observed ex-ante properties and expectations are met. It is this, rather than performance, that tests a strategy's success. An analysis of last year's poorly performing trend strategies illustrates the trend allocation did badly, as the whole CTA industry did, but that was entirely in line with our expectation. It was actually what we wanted." Wow. I would love to have those guys as clients. I've had clients like that who kind of got it and understood it and saw, even if it's not a crisis alpha, it is a great functioning part of the portfolio that is going to add some diversification exactly the time you want it when your stocks are getting crushed? Probably not. But certainly CTA trend following with all the markets is doesn't always work, but it there has been times, 2013, where we did well and the stock market did well. And so that was the only trend, the best trend going, and we captured it and we did very well that year. So that's fine too. But, last year was tough and this year's much better.
Yeah, there was another quote from that article actually where they went on to say, when we look at our performance, it's not really in the context of good or bad. Instead, we ask if that performance was in line with our expectations and decisions. Think of it as ordering an espresso and making sure you get an espresso. So, yeah, I think they make some good points. What I'm not so big a fan of is that they decided a couple of years ago, to take their CTA allocations and do it in-house. So now they, well, the good thing is they're still doing quant strategies. But I've seen examples of this where people think what we do can just easily be replicated in-house. But I've also seen a lot of examples that the results that people get is not nearly as good as allocating to people who've been doing it for 3 or 4 decades. So that's my concern, that people might think, oh, but if we hire a team of 10, that's going to be cheaper than paying X percentage management fee and performance fee to these managers. But it also comes down to, at the end of the day, what performance do you get in return? And as I said, certainly seen examples of that not panning out so well. But I like the article as well, by the way, Jerry. Yeah.
Oh, yeah, that was a good one. The next one I liked was about Warren Buffett and how he stuck with his strategy over all these years, even when he underperformed by 6% over a 5-year period, and then the following 8-year period, he beat the S&P by 10%. I thought that was really good. Buffett's great returns have been earned by having conviction in investment principles and having the discipline to stay the course. The great tragedy is that while so many investors idolize him, they fail to take his advice and invest just like him. So I ran out of space, but I wanted to say, same with us trend followers. People may like it, they may talk about it, they say they like it, they want to invest in it, but they need to have the temperament and the discipline to keep the money with us, because they play a huge role in whether their investment with us is going to be successful.
Yeah, no, absolutely. And coming back to sort of the earlier point I made today about these drawdown analysis. I mean, it can be really hard to sit through drawdowns, and it reminds me of this story we've talked about in the past about when Fidelity did some analysis on which of their clients were generating the best returns, and it turned out to be people who had forgotten that they even had an account with Fidelity. So they were really doing nothing and just leaving the money there to do the work. And of course, I don't know if it's different if you had a long-only strategy where you really could, become scared if it's down 50%. But of course, we as humans, we tend to make judgments based on possibilities rather than probabilities, meaning if it's down 50%, it's possible that it's going to drop another 50%. Of course, sure. Like when you go on a plane, I mean, it's possible that that plane is going to have a crash, but it's not really probable. And of course, we think as managers much more in probabilities, and we look at all these statistics that we have for previous periods and how we fared and what to expect. And of course, every time is a little bit different. The drivers, the levels, the length, etc., etc. But there are some patterns there to be had. But of course, the most important part is just having this super long, investment horizon and not get too worked up if you have a great period or a bad period, so to speak.
It seems everything that we do is just built up around capital preservation and money management, the small losses, the diversification, the shorts, paying attention to price only. When I first got started trading, I was told, like, make a lot of small decisions. You want these decisions to be very small. So trade small. Don't put yourself in a situation where you have to cross your fingers and say, please, God, let me out of this, and I promise not to ever do this again. And I think that you want to make your strategy like that, so you don't put yourself in a situation where you're facing these crazy drawdowns or crazy risk. And at the right, just at that time, you would have a tendency to give up at the bottom of your drawdown or bad period. And you don't want to put yourself in that situation. So I think even if the passive long only stocks continues to work like it has in the past, that's not good enough. That's bad. It's people are frequently in situations where they're going to be tempted to stop following it, which I'm not saying that's necessarily a bad thing, especially if they stop and they start doing more of a trend and more of a diversified approach. But certainly it's not going to be successful if it's even possible to be successful if you put yourself in a situation where you're continuously testing yourself. Can I do it? Can I do it? Can I continue to do it? And your brain is telling you these 50% drawdowns are not healthy. They're not something I should put up with, and I agree with that.
Yeah, it reminds me actually. This week I got an email from a great listener of ours called Alfred, and I'm sure he'll be listening today. So hello to you, Alfred. He was very kind. He sent me a write-up of something that he had done that kind of analyzes the impact of bet sizing or position sizing and how much it changes when you go from 50 basis points to 100, 150, 200, etc., because of the randomness in terms of winning trades and losing trades. We don't know exactly in which order they will occur. There's a huge difference in terms of how your account size will evolve, because if you bet too much and you're unlucky with a losing streak, I mean, it has a devastating impact on your account size. I don't remember all the details of it, but it was a really interesting write-up, and it kind of goes back to what you've often said as well, and that is, we take small positions. We want to make sure we're there to fight another day. So very valuable lesson indeed. What else did you come across, so to speak, Jerry? We've got a few questions, not that many, but we got a few. We can certainly do a tweet or two more if you're up for it.
Yeah, let's do one more from one of my favorite writers, Andy Kessler. He wrote in the Wall Street Journal last day or two about the markets and how to think about the market in general. And I like this quote. Of course, it suits me, so I like it. The market is investors' collective intelligence. It isn't always right, but it definitely broadcasts meaningful sentiments. It's sharper than any poll or committee, let alone one person making decisions. So that's what we've built our careers on, that the market is the best idea. It's the wisdom of the crowds. Now, since we have about 60% of our trades are losing trades, it's not accurate, not a good predictor all the time, at least when you throw in the fact that you're going to try to keep the losses under control. You have to sometimes get out and get right back in. But I'm often reminded I'd much rather follow the price than anything else.
Yeah, and that reminds me actually. I was interviewed myself yesterday for a podcast episode coming up on Macro Voices on Friday, I think it is, and I was asked about this group Nomura, about how they put so much emphasis on research that tries to anticipate the signals of trend followers to make it sound like this is really important. If the S&P hits 2950, you're going to see massive selling from CTAs, blah, 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 blah. And I thought, my answer to that, not that I should, maybe talk about it too much before the episode comes out, but my thought process at least is that why would you put too much emphasis on anticipating a CTA signal if you knew that 60% of the time it's going to be wrong? So it just makes no sense to me that it gets so much press, because what people forget in this context is that the reason why trend following works is because we do this in so many markets at the same time, long and short and all of that. So that's the secret sauce. And so again, when I see things like that, and it's not to sound critical of other people's work or analysis, they have their, they do, what they think is best, but it does annoy me a little bit that it gets so much press that they think that, wow, this is the holy grail. We can anticipate what these managers are doing, so we should just follow those signals. Yeah, but you're doing it in one or two markets. I mean, you're missing the whole point, and you will end up getting a bad. This is why I think a lot of times trend followers get a bad rap, because people read a book or they listen to something and they think, yeah, I can do that. I can read up on this and I'll just do it in 3 different stocks and I'll be fine. No, you won't. Or you may, but it will be more luck than anything else. So just my little thought after hearing that point.
I also saw an article I was interested in this week about Milburn, which is a longtime CTA.
Yeah. Oh, yeah.
Focusing a lot of resources on artificial intelligence. And thought that was pretty interesting. Not going to discourage anybody from taking their billions and de-emphasizing trend following. I think that's fine with me. When I first got into trading, I would hear about new managers and the latest and greatest manager that people were allocating to. And the only question I was interested in is, are they trend following? And most of the time, no, they're not. So happy, so relieved. So go for it on the AI. I joke around about AI that I'm sure AI would be just fine, especially if your last decision was if AI is sort of signaling a buy, then I think the last decision should be, okay, it has to be a 50-day high. So if you throw in a little bit of trend following, I'm sure AI would be vastly improved. That's what AI is going to come back and tell everyone is just throw a little bit of trend following in there and it'll vastly improve their decision making. But should be interesting next few years as this more and more happens with this sort of technology.
Yeah, no, I completely agree. Now, the first question we have is from Adrian. Adrian, I believe, I know actually, he will also join us in New York in a few weeks. So we look forward to that, spending a couple of days helping a small group of people get some breakthroughs in their trading or business. Adrian asks one question. Maybe you can ask the panel on an upcoming episode. The panel is you and me today, Jerry. What is your rule of thumb for liquidity of any of the instruments you all trade? Futures, stocks, ETFs, options, etc. So let me throw it to you first, Jerry. Do you have specific rules, criteria for liquidity in the markets you have in your portfolio?
We have rules. All the markets we trade are liquid, and they're not too small for our size. So we haven't really faced that issue very much. I think a good way of looking at it would be, how many do you usually have to buy or sell? And what is on the bid and the offer, quantity-wise? And then how wide is the bid and offer in terms of the average true range? Something like that. So, it gets back to your trade stats. And if your average trade is 2 or 3 ATRs, then you have to build in your slippage, and slippage is going to be somewhat indicative of the bid and offer spread. So, it sounds a little technical, but I think that's where the rubber meets the road. How hard is it going to be to get the trade off, and then how much is it going to cost you every single time to trade?
Yeah, no, I think that's absolutely true. On our side, it's the same thing. We do quantify it though. So we do have rules in terms of, how much of the daily volume our positions can be. So these are very hard and fast rules that we have. Again, with our size, we don't really get to those levels yet. But I think it is important that, as Jerry said, you need to be certain that if you need to get out of the market, that it's not going to be difficult in any way, shape, or form. But I think nowadays, if you trade a diversified portfolio, you should be able to get to, $3 or $4 billion under management if you have multiple time frames and et cetera, before you run into real liquidity issues. But one thing that concerns me a little bit, perhaps, is that my sense, at least, is that the very large managers, in order to get more capacity, have started to go off exchange again. And I'm not necessarily sure that that is a good thing. I mean, I think our industry is really known for being super liquid, for good and for bad. Obviously, we're going to be used as an ATM from time to time when people need liquidity. But I think that's the role we play, and I think we should continue to do that. So if you start deviating from liquid exchange traded products just to get more capacity, you kind of introduces some other risks that at least investors should be aware of, I guess.
Do you remember, last year or two, that there's been some large CTAs that sort of started new programs of maybe less liquid or over-the-counter markets? I didn't really, I like that. I mean, I like adding these new markets, and I have a list of markets that I want to add if liquidity gets better. But I think their point was these markets that we've been trading or that we currently trade in another program, or the liquid ones, they are overfished. There's too many people there. And so the trends are not going to be good. Our strategy is not going to work very well. So let's go find the markets where there's no one there, and not as many trend followers. And I didn't like that idea as much as just purely finding markets that add diversification in different types of stocks or commodities in particular that are vastly different. So I'm really sympathetic to that idea, but I don't think I agree that let's go off exchange or let's go trade something that's not that liquid because it should trend better. We've seen a lot of nice trending markets here recently, and they're very liquid.
Yeah, no, I think that is a good point. I think, again, it's all about finding an edge, I guess, and also especially when you're building your firm, you have to be a little bit different from, the next guy who's been around for 15, 20 years, because otherwise you won't get, a seat at the investment committee table, so to speak. And so I've interviewed a couple of managers that do focus on, exotic markets and have done so with success for sure. And I can see a case for it if you, and that there could be, because there are smaller markets, that there could be some really big trends. I mean, of course. So again, if you can find ways around your risk management and making sure you have liquidity, which could be an edge in itself, I think it's okay for people to do that. But I completely agree with you. I don't see a problem in trading super liquid markets from a trend following perspective. Meaning, I don't subscribe to this fear of markets being overcrowded or the trend following doesn't work on super liquid markets. I mean, bonds are probably as liquid as they can get, and that's where we've been fishing this year. So, but I think it's okay to try and be different. I think that's okay actually to do so, as long as investors are aware that it involves different kinds of risks. But of course, we also know from AHL, I mean, their evolution program has been known for trading markets that are not maybe the usual suspects, and they've done that with success. And yeah, that's fine. All right, let's move on to another question. This time from Nuno. And that's an interesting question, actually. He says, let me ask you this. If someone were to come to you and present you a systematic strategy, what sort of questions would you be looking to see answered? What sort of details would you be looking for? Now, Jerry, you, I'm sure in your long career, have probably met a few trend followers and maybe even considered investing with them. I don't know. Some of the things that interest you when you look at other people doing what we do.
I feel like my answer is so boring on this, and I'm so close-minded in this area. I would say holding period. Never been a fan of really short-term trading, so I like to see weeks and months and years possibly. Prefer months and months of holding. But average win, average loss of the trade, the win percentage. I think these the building blocks of good performance. I think the historical back test of the fluctuations of the equity curve can be misleading, either good or bad, more so than those basics. What are you getting at? What do you think you're getting at here? Tell me what you're thinking and what the market has told you or is telling you that works. And philosophically, what are you trying to do here? It's easy to say capture long-term trends and minimize the volatility through trading lots of different markets and longs and shorts, but other people are doing other things, and they should be able to do the same thing, put it into a couple of short sentences so I get a real good feel for what's going on and what they think they've uncovered. And of course, my usual sample size, how did you count your sample? How did you count the trades? How many, etc. So I think it's not a very interesting answer, but I have allocated a lot to other CTAs, and I never probably asked them very many questions. I would just usually invest with people who had long track records, maybe different strategies than mine, different holding periods. But so I think it's much better, and I don't like listening to these answers and having my decision about how much to invest influenced a great deal. I prefer just to say the track record looks good. I understand what they're doing, and I'm going to allocate a small percentage to a lot of different managers versus, this one really excites me, and I feel like I understand it better and more, and they've had a great performance, so I'll over-allocate. So I think I'm not in favor of over-allocation. Small, the same for everybody, small amount.
Yeah, I mean, all good points, of course. I would say that I also find it interesting to, if it's at all possible, to dig a little bit deeper when it comes to how the strategy has evolved. Meaning, certainly if they've been around for a while, you would think that they've made changes along the way, and also that they have done research which may not have actually been implemented. So I think it's important to understand a little bit about the journey that they have done from gone through from a research point of view. Why did you come to that conclusion? Why did you think it's better than what you did before, etc., etc. And interestingly enough, there was an article this week that someone shared with me. I think maybe it was an Institutional Investor or something like that, where they talked about what really, how do hedge funds, who are the best people in terms of raising assets. And it turned out that they said people who are very clear in their communication. If you can be really, really clear about what you do, why you do it, why it works, instead of coming up with all kinds of elaborate, complicated, explanations, but just keep it very simple but clear. That, in their analysis, have tended to be, what works best in terms of winning the trust of investors.
I have a funny story. Reading the monthly newsletter, that can help. I remember back in the early 2000s, I feel like our trading got off track a little bit and we had too many things going on things that I don't agree with now, and I never really agreed with, but research was just ramping up a lot of ideas and trying to minimize the drawdowns, and I think in a non-robust way. And then I'll bet after the first 4 or 5 months of trading these new signals, we saw performance that we had never seen in the back test. So, this performance was not good, and nothing. And this is sort of probably the definition of over optimization. The back test looks great, and then when you implement it, you have months that don't look anything like the back test, obviously worse. And so we came to this conclusion to stop. We need to stop. Let's get back to what got us where we were, robust trend following. And, part of that is just accepting you're going to have these drawdowns. And so I read a monthly letter from another CTA about the same time, and he basically said the same thing, that they had made all these changes the prior year, and they realized that if they had not made those changes and traded the old methods, they would have made money. It would have been a great year. Everything was fantastic. Everything would have been fantastic. And but his conclusion was the exact opposite of mine. Double down. We're going to double down on this research. We're going to make it better. We'll just keep going down this path. And I thought, oh, wow, that's interesting that I felt guilty and wanted to turn around and get back to what I thought was the basics. And but I do think that they went another direction. And I'm not saying they weren't successful. I don't really remember. But if, things like that, just simply reading the monthly commentary, what are they saying about losing periods?
Yeah. By the way, someone told me, I think last year, when the industry was going through a tough time, that there was a correlation. The worse the performance, the longer the monthly newsletter. So, so yeah. I also think, just staying a little bit on I think Adrian's question, or maybe it was Nuno. Trying to really understand how they do their research and especially how they test things, etc., etc. We certainly get a lot of questions about that. People who really wanted to make sure that we don't fall prey to some basic mistakes when it comes to that. And I also think because when it comes to how you do these things, I've always found it fascinating that firms with just a few people in research really can compete with firms that have 50 or 100 PhDs on staff, even though that can be sometimes a little bit counterintuitive for people to buy into. Why should we, as a firm with I think we have 3 or 4 PhDs on our staff, why should we be able to compete and maybe even outperform people with 50 PhDs? So I think that's another thing to that helps if you really try to understand what the research, so to speak, what is the process. And also I think the other thing, just generally speaking, now that I'm thinking about it, sometimes I think it's also important to understand what are the backgrounds of these people, because I don't necessarily believe that it's a good thing to just hire people from the same universities. They've been given the same books. They come with the same kind of basic grounding. Why not find people that comes with a little bit of a different background that can look at maybe some of the research that has been done in the past, but with a different set of eyes. I certainly think on our side, some of the people on our research team that have come up with great additions to the strategy, they didn't come from a CTA shop. They actually came from a different kind of strategy shop, but marrying trend following with what they had learned in their prior lives has really paid off. So yeah. Thanks so much, Nuno, for your question. Last question for today from one of our favorite listeners, Sam, of course, who left the first voicemail last week on our little new facility or recording facility. So Sam goes on to say, in the past, you all have fielded questions related to max loss if all positions reversed. I don't think it's unreasonable to visualize a common situation where this number is close to 100% or even more. Jerry has referenced letting all positions reverse hundreds of basis points from equity. This could very easily amount to 100% loss. But let's focus on a more realistic outcome. What maximum loss to risk are you willing to accept when it relates to one driver, in quotation? How do you measure singular event risk and manage them? Let's say the Swiss franc move of early 2015 affected the dollar or the Swiss. This would affect a lot of positions. It's not unreasonable to say an extreme move in currencies could move the portfolio 10 to 25% to the downside, using Jerry's mantra that he will let positions retrace hundreds of basis points. I'm quoting Sam here. I'm not necessarily saying this is what Jerry said. If this move were dollar related rather than Swiss related, how would you manage it? What's the max loss of equity you're willing to accept due to one return driver completely reversing on you and hitting your stop loss? Swiss franc breaking is a premier example. It was a 23 ATR move. This can't be ignored. Okay, so that is the question raised by Sam. Let's hear what your thoughts are, Jerry.
Yeah, 23 ATR move in one day or one night or instantaneously. It was, and then that was unfortunate. But it was one move. It was one market, and it was not spread out through all of the currencies. But and then he said, "How much am I willing to accept?" In that particular situation, I had no choice. It just happened, and so if it's a gradual, hundreds of basis points for profitable trades, these are very profitable trades, and we're giving back profits, and it happens over months or weeks versus overnight. I don't have much choice if it's overnight or very quickly sometimes, but I do think he brings up a good point, and that is, and I quoted him earlier by saying that he tweeted something about every currency going against him in January or February and his worst month ever. And I think that is the point right there. This decision needs to be made beforehand of how much risk am I willing to take in the currency sector or the grain sector or stocks or metals or bonds. And so I think this is the type of decision and when it needs to be made, not when you're in the midst of it. On record as saying the systematic approach, you should not treat it like religion, that I'm going to follow it all the time. It's going to sometimes it breaks, and you do have these give backs, whether they're profitable trades or not, and you have to try to limit that give back in and have a money management overlay. I'm not in favor of a money management overlay that kicks in daily or fall targeting, but I am in favor of acknowledging that the drawdowns can be too large, and you have to step in when there's system failure, let's say.
Yeah, I mean, I certainly have a few thoughts on the topic, and thanks very much, Sam, for your question. I mean, there are obviously different ways to do risk management and trying to avoid, an extreme situation, as you described, Sam. And I think the first one really is just portfolio construction. And as Jerry said, making sure you have enough diversification in the portfolio. I don't believe that you can get hit in all of your positions or stopped out in all of your positions if you are really truly trading a diversified portfolio. But the way we look at things on our side is we look at the portfolio level in a slightly different way, maybe because we look at it from a value at risk point of view. That's how Bill Dunn started back in the 70s, and that's still how we manage risk. And so, risk is not something you can, it's always going to be an estimate, right? We're always estimating what the risk is. We don't know exactly what the risk will be. And so when we look at our daily value at risk, budget or expected value at risk. We will, of course, on over say a period of a year, there will be days where you penetrate these risk bands either to the downside or the upside. So having these slight outliers is definitely possible, and you need to do that, or you need to have those, I think, in order to be sure that your risk management method is correct. Because if you had no outliers, if you're always within your expected risks, then I think that's probably more worrisome, because then maybe the way you do the estimation is not correct. So I mean, in the case of the Swiss franc back in 2015, I think we lost like 1% on the Swissy that day. So not a big thing, and I think that comes down to again massive diversification, not relying on any one market. And so on and so forth. But of course, we've also seen that in February of 2018, where there was a few days in a row where clearly you were suffering 4 or 5% losses 3 or 4 days in a row. So these things do occur, and you need to build it in a robust manner. So we don't think about so much, how much risk are you willing to lose in any one trade, because we're not looking at it on a trade by trade basis. We don't use stops on our side. So it's a different way of doing it, but it's from a statistical point of view, we know what to expect. And then on top of all of this, we run stress tests on an ongoing basis. So we want to see how the current portfolio would behave through different historical, really stressful periods, like the 87 crash, like I think we had the long term. I think we also look at a period where long-term capital blew up. I mean, there are a number of really stressful times in the market. So you want to make sure how that would impact your portfolio as well. So there are many ways of doing it, but as I said, it's not an exact science. I mean, we are estimating how the portfolio will react and what risks we are taking, because we're dealing with markets that move every second. So you can't be 100% sure what how it will pan out. Does that make sense, Jerry?
Yeah, just overall maximum risk, in your portfolio that you're willing to take. I think that is, it's kind of ironic that with futures markets and with sizing based upon ATR, for instance, we can put together a portfolio that seems almost all of the time to be, more diversified and safer, and yet we are using leverage, and we can see the volatilities get much higher than they were just a few weeks ago. And so we are prone to, or we can have situations where our risk can get out of control. So we need to be ready. But it's most of it should be planning ahead of time, that your max risk overall and your max risk per market and per sector is sort of normal and low, and positions are different and diversified, and then get ready to cut back even further.
Yeah, I mean, what I like about your question, Sam, is the fact that you focus on the risk management side, because that's really where we start. I mean, I think a lot of people believe that trend following is about how much money can I make, but actually I think that people will be surprised that we spend most of our time, because that's the only thing we have some control over, is really the risk management. We don't know how much the strategy will give us, but we certainly have some ways of controlling risk. And so I like the fact that you focus on this, for sure. I think that's the right place to the profits will take care of themselves, I think, but you need to be there to play every day. So you need to have good and sound risk management. And I just for rereading your question, how much are you willing to accept due to one return driver? Again, even defining one return driver can be very difficult because sometimes a move in the Swiss franc will have an impact on other things. Sometimes it won't. So I think just massive diversification is super important to avoid having to rely on guesstimates like that. You look like you wanted to add something, Jerry.
Oh, well, no, but I was thinking that I was on a radio show this week and they were asking me about stocks and putting together a portfolio of stocks. And I said something kind of crazy, which is, I'm not necessarily focused on trying to find the best stocks, to own because I don't think I can predict that. And I don't think it is sort of predictable. And I'm much more interested in trying to find real diversification in the stock sector, which hopefully gives me some longs and shorts. So that is another way to know, do I have good diversification? This driver question is, I never understand exactly what other people mean by that, but if you look at your sectors and you're short everything in the sector or long everything in the sector, you probably don't have a lot of diversification there. I'm afraid. So sometimes that happens though, and but these are tough questions, and I think a lot of it I hear these same questions coming from smaller traders who have to make tough choices. They have to. They don't have a lot of capital under management, so they have to choose the markets to trade, and they're going to trade them fairly large, effectively, because they don't have a lot of capital. So,
no, absolutely, and I think that's something we definitely come across, and some of the emails that we've had from listeners as well is that challenge, and we know it's a challenge. We may give you answers that are impossible for you to implement in your own trading right now, given account size. We understand that challenge. Nevertheless, we're just trying to give our view on what's the best way forward, but it may be something that will come later if you're trying to do your own style of trend following. But which always leads me back to this point about that, sometimes it's better to maybe consider allocating to people who have the ability to give you that diversification until you're ready or big enough to do it yourself, because it is a key part of the or ingredient in the secret sauce of why trend following works, I think. Those were the questions. Now, normally I would do a little roundup of performance numbers. Funnily enough, when I was looking at the data today, our friends over at SocGen have not updated any of their indices this week, so I don't have much really to go on here. But the B Top 50 index, which is the top 20 managers open to new investment, so a lot of the big guys. As of Thursday, so not counting yesterday, which I think was probably a positive day for the industry, I would imagine that. It did finish August around 3.23% for the month, so maybe a little bit higher at the end of Friday. And it's up about 12.04% for the year. So clearly having also a great year so far. And then we have the Bridge Alternative Index, which is flat fee funds. That is, again, as of Thursday, up 6.31% for the month of August, up 16.04% for the year. So again, having a very good year on that front. Anything else on your side, Jerry? Obviously excited to be back next week with our 1-year anniversary episode. Not sure if we've got anything particularly special planned. Maybe we can think of something. Maybe our followers will just give us so many voicemails the next coming week that we can just play them all, not do anything else next week. Who knows? Or maybe they'll come up with some good ideas for us. What about you? Any last final thoughts today?
Oh, I didn't weigh in too much on the markets, but there were some nice moves yesterday in platinum, following gold and silver belatedly. Nickel, palladium, nickel and palladium had a big day yesterday, so it looks like some things are happening and new trades. Wayne tweeted something this week that I didn't mention, but it was something like, treat your exits as possibly great new entries. And so I think sometimes I get so focused on taking a loss or getting out of a trade that was a pretty good trade, and you're kind of bummed by it because you lost money or you had a drawdown in a particular trade. But sometimes it's just an opening of a new opportunity, go in the opposite direction. And so I think we're seeing a lot of interesting market moves, and as I've said before, the longs, tend to do better than the shorts. So hopefully we see some follow through, and this year gets even better.
Yeah, I mean, as we've certainly talked about before, because there was definitely a period with below average returns, you would expect over the long run that this will be followed by a period of above average returns. Maybe 2019 is kind of the beginning of that. Interestingly enough, the drawdown analysis that we did last year that I referred to in the beginning, we also followed that up with, what happens in the next 3 years after you recover. What kind of returns have we seen in that 35-year period? And actually that, I have to say, were quite encouraging in terms of that. So maybe we are just in, much more of a global macro environment, which I know a lot of people believe we are. And it certainly looks like it when you look at the potential drivers of market moves around the world right now. So just hang on to those trends, I would imagine. Anything else? I guess the other thing I could suggest as we come to a close is that if you want to mark our 1-year anniversary for the show, of course, you're also extremely welcome to leave us a rating and review in iTunes, because that really helps other people discover the show. So feel free to do that. Anything else, Jerry? Or should we just wrap it up?
I think that's a good show.
Good stuff. From Jerry and me, thanks so much for listening, and we look forward to being back with you on next week's edition of The Systematic Investor. And in the meantime, have a great week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks